Of course, we're doing 30 million right now, but we started 4 years ago with 110,000.
Wow.
So as you can see, that's pretty phenomenal returns.
Remember these two lads in Big Shot? Yep. I realized there's a video on YouTube about their trading strategy. So here you go. Welcome to Quant Program. And today we will discuss about Brownfield or Cornwell Capital and how they made their fortune. Now, the devil is in the details. Firstly, you all know what an option is, but there's two additional things you really need to know. One, how options are priced. Two, what are leaps. And three, putting it all together. Now, leaps are pretty simple. It's long-term equity anticipated securities. In simple English, it's option contracts with expiry of more than a year to 3 years. Now, options are priced by this complicated equation called Black-Scholes option pricing model. High-frequency firms use this to price their options. Now, I'm not going to go into details in this equation. That's a completely different video, but it's important that I talk about a few of the assumptions this equation takes. One, volatility is a constant, and two,
Black-Scholes is what I would call a know-nothing value system. If you don't know anything at all about value compared with price, in other words, if price is teaching you all that can be known, then Black-Scholes on a very short-term basis is a pretty good guess.
the volatility assumption is a big problem. Now, for short-term duration, this assumption is fine because most likely the trading ranges are similar for the next few days. But hey, not for after 3 months, nor after 1 year. This is essentially one of the biggest advantages that Cornwell Capital had. By buying far away expiry options, they have a massive advantage of this mispricing. Now note, this mispricing is not only in the puts, but also on the call side. But Cornwell Capital went even a step ahead. Strong companies that are super unlikely to fail will have even cheaper option prices for puts because their failure is extremely unlikely. Now, this mispricing is substantially large here. It's as equal to buying a leap put option on Facebook or Apple today. Nobody expects it to fail, but we don't know in 1 to 3 years. Maybe. Could Apple be the next Nokia? If this bet is right, imagine the money you could make. And if you're wrong, the loss is so small, it's pretty irrelevant. Now imagine doing this for 30 or 50 stocks. The chances for you being right in at least one of them going crazy low itself is big. Now forget about 1 or 2 stocks going lower. The overall stock market itself could have a mini crash anytime in the next 1 to 3 years. And now you have made money on practically all the puts that you have bought on these stocks. Now, coming back to the Charlie Munger statement, yep, Black-Scholes don't take into account the value of the stock in consideration. Now, the Black-Scholes equation, they don't know what the stock is. Is it a good company? Is it earnings or revenues for the past 10 years good? Nope. They just put the numbers in there and give you a price for the option. That's it. So people like Warren Buffett, they take a completely different approach to Brownfield Capital. Let me give you a very simple example of a leap call option bought just a few days prior to COVID crash last year. So to start off with, this is the Think and Swim trading platform, and here we have a really convenient facility to go to the date prior. So in this case, I've taken 02/19/2020. So this is like a few days before the coronavirus crash. Now, what will happen if I buy a call option leap, which is like 394 days away from expiry? So I bought at the money call option here at the strike price of 339. So let's see the results here. So if I bought the leap a few days before the coronavirus crash, obviously I would have lost a sizable amount of money during the crash. But because it is 394 days away from expiry, it had enough time for it to create some great returns. And eventually, at the moment today, we would have made $30,000. Now imagine if I'd bought leap put instead. Now if I bought a leap put, because of the coronavirus crash, I would have made a sizable amount, almost $90,000, and that's quite a huge return for the leap put. So basically the duration of these leaps itself is another massive advantage. It simply gives you time, and combined with mispricing, you've got yourself a great strategy to play with. I would really appreciate if you share with this with your friends. Don't forget to subscribe. Thanks much for watching.